Right then, gather around. Did you know that some of the biggest companies you hear about, the ones splashed all over the news for making billions, sometimes end up with absolutely nothing left in the bank? It's true. It's like throwing the most fabulous, star-studded party imaginable, only to find out at the end of the night that you've spent every last penny and can't even afford a taxi home. It's a bit of a shocker, isn't it? You see these massive numbers and think, well, they must be rolling in it. But the story is often far more complicated and, frankly, more interesting than just the headline figure. This isn't just for bigwigs in shiny towers, it's for everyone. If you're starting a business, working at one, or investing your savings, you absolutely must understand the difference between the money coming in and the money that actually stays. It's the secret between a business that glitters and one that is truly gold. Today, we'll pull back the curtain and make this simple over coffee. Let's start with the big one, revenue. What is it really? Revenue is all the money a business brings in. It comes from selling goods or services. It's the total sales figure before any expense. The top line of your financial story. Imagine you own a charming coffee shop, the Daily Grind. Every time a customer buys a cappuccino, a slice of lemon drizzle cake, a fancy panini, the money goes into your till. Add up every pound and penny over a month. That total is your revenue. Let's put numbers on it. You add up the sales and find $5,000. That is your revenue for the month. It's a fantastic number. Revenue equals sales price times number of units sold. Feels brilliant, right? Maybe a holiday or a new espresso machine. But hold your horses. $5,000 is not your profit. It doesn't include the coffee beans, the milk, the sugar, the paper cups, the wages for your barista, the rent for your shop, the electricity bill, the marketing flyers you posted. All those costs must be paid from that $5,000. Revenue is a vital indicator, but it measures scale, not success. High revenue equals busy. Profit equals smart with money. The real magic happens when we subtract costs from the top line. That's where profit lives. Now, let's get our hands dirty and start calculating. All right, we have our starting figure, $5,000 in revenue for the Daily Grind. Now we take our first step, gross profit. Gross profit is what's left after you subtract the direct costs of making what you sold. The coffee beans cost $800, milk, sugar and syrups $500, baking ingredients $700, $800 plus $500 plus $700 equals $2,000, your cost of goods sold. Gross profit equals revenue minus COGS. Step 1. $5,000 minus $2,000 equals $3,000 gross profit. After paying for the ingredients, you're left with $3,000. This is your gross profit. It shows your core model works. You sell for more than it costs to make. But this $3,000 is still not take-home money. Think of all the other costs of running a business, operating expenses. Barista fund $500, rent $800, electricity and water $200, marketing $100, total operating expenses $2,600. Operating profit equals gross profit minus operating expenses. $3,000 minus $2,600 equals $400 operating profit. It shows profit from core operations, day-to-day efficiency. Can you pocket the $400? If only it were that simple. One more hurdle remains, non-operating costs. Interest on the loan for that shiny espresso machine, $50 a month. Taxes, $100 this month. Together, that's $150. Net profit equals operating profit minus interest minus taxes. 400 minus 50 minus 100 equals $250 net profit. After all is said and done, your net profit for the month is $250. From $5,000 in revenue to $250 in net profit, the real profit. That's the money you can reinvest, maybe a new cake display, or take home. High revenue can hide high material costs, expensive rent, inefficient operations, or heavy debt. $1 million in revenue with $1.1 million in costs loses money, while $100,000 with $70,000 in costs is nicely profitable. Now that we understand the different types of profit, let's talk about profit margins. A margin turns your profit figure into a percentage, making comparisons easy. It tells you what share of revenue your profit represents. There are three main margins: gross, operating, and net. Gross margin is gross profit divided by revenue times 100. For the daily grind, $3,000 over $5,000 gives 60%. Operating margin is operating profit over revenue times 100. That's 8% for our cafe. Net margin is net profit over revenue times 100, which gives a 5% net margin, 5 pence per pound after every cost. A 5% margin might sound small, but in food and beverage it can be typical. Margins help you see beyond raw numbers to true efficiency. This isn't just theory for a little coffee shop. It happens every day with the biggest companies. Let's look at a real-world comparison. We'll compare two giants everyone knows, Walmart and Meta. Walmart generated around $600 billion in revenue. Huge inventory, thousands of stores, and over 2 million employees, enormous costs. After those costs, net profit was about $12 billion. That's roughly a 2% net margin, 2 cents kept per dollar sold. Meta's revenue was around $120 billion. Different cost structure, ads revenue, data centers, R&D, salaries, no stores or inventory. From that, about $24 billion in net profit, roughly a 20% margin. Notice, Meta's profit is double Walmart's from only a fifth of the revenue. Neither model is better, just different strategies. The company with the biggest revenue isn't always the most profitable. And there's one more gotcha we need to cover, cash flow. Profit and cash are not the same thing. Profit is an accounting concept on paper. Cash is the money in your bank. A business can be profitable on paper, but have no cash, and fail. Imagine a $1,000 catering order. It's counted as revenue and profit is calculated. But payment terms are 60 days. Cash hasn't arrived. Meanwhile, you must pay rent, your barista, and suppliers this month. That's a cash flow crunch. Manage timing. Invoice fast. Chase late payments. Schedule bills wisely. Don't tie cash up in excess stock. Always watch your bank balance as closely as your profit and loss. So there we have it. From a dazzling $5,000 in revenue down to a hard-earned $250 in net profit. Revenue is activity. Profit is what you keep. Start with total revenue. Subtract cost of goods for gross profit. Subtract operating expenses for operating profit. Subtract interest and taxes for net profit. Always monitor cash flow. Remember our tale of two giants. Next time you hear record sales, ask, what was their profit margin? Learn how to read a financial statement next. Subscribe for weekly finance tips made simple. Watch how to read a financial statement.